Hello, friends, and welcome back to Market Shares. I'm your host, Tony Blodgett. And hey, welcome to 2026. This is our first recording of the new year. I hope everybody enjoyed the holiday season, right? I mean, it starts with Thanksgiving and it just feels like it doesn't end. So hopefully as we're all getting back to work this week, everyone is rejuvenated and ready to take on 2026. I think it's going to be a really good year. I'm actually going to review an article today that was written by Logan Mohtashami with Housing Wire. And Logan doesn't do podcast interviews anymore. He has his own podcast. You should check it out. I want to give this quick overview, though, because I think it gives a pretty reasonable look at what 2026 has in store for us. But before I do that, I've talked about this on the podcast before. I've talked to a good handful of people over the last few days that are like, it's January, so we're going to do dry January. And I think this is something that I am in a good position to speak to just briefly. So feel free to skip through this section if this doesn't apply to you. But more and more people in the United States are choosing to consume less alcohol. And I think the number of people, it's like 36 to 40% of people that were polled said that their goal is to consume less alcohol in the future. And many people do that by participating in things like Dry January or Sober October. You've all heard of these things in the past. And it was actually a Sober October that I did years ago that led me to quit drinking altogether. And that's why I bring this up, because I think that anybody who's considering taking a break from consuming alcohol might be in a place where they want to change their relationship with alcohol, maybe forever. Maybe it starts with a 1-month plan, but it might evolve into something more. So I'm going to give everyone a tip, because people often ask me, how did you just quit drinking, cold turkey? And I share the story that I was doing a Sober October, as I used to do every year when I was drinking. And I'm not going to tell the whole story here. I've told it before, but the bottom line was I was introduced to a book. And the book is called The Easy Way to Control Alcohol by Alan Carr. And I'll have our team put a little picture of that up here on the screen so you can see it. And I would highly recommend that if you're doing dry January, and it could be, this is probably coming out the first week of January. So you might be watching this and be like, yeah, I planned on doing dry January, but I've already failed. I've already, broken my New Year's commitment to do dry January. And that's fine, to be honest with you. That's fine. The cool thing about this book, is that you can actually continue drinking while you're listening to the book. And I highly recommend the audio book for people that want to read this. And even if you aren't considering, quitting drinking or doing a dry January or whatever, I think it's just a good book overall. I think it gives you a different perspective about alcohol consumption. And look, there's something happening in the U.S. because we are at a all-time low in the number of people that are consuming alcohol. And there's a number of reasons for this. I think a lot of young people just are really, because we definitely see it in the lower, the younger demographics. And we don't see it as much in the 55 and over range for whatever reason, but it's definitely something you see in the younger age demographics. Maybe it is, a post-COVID thing where people are more focused on health or whatnot. Maybe that younger generation just missed out on going out to the bars and that whole scene, in their early 20s because it was locked down, and we have a whole, 3 or 4 year gap of people who never got in the habit of doing those sorts of things. I don't know what all the reasons are, but I will just tell you that statistically, the numbers are down, which I think is a good thing. I think that too many people overconsume and as a result are not operating at their highest and best all the time. So I would just recommend that book. I want to mention it because I've already heard multiple people mention dry January. And for me, choosing to not have alcohol as part of my life has been, I would say, one of the number one things, probably the number one thing that I've done for, my career, my, just everything, my health, my relationships, everything. I talk a lot on this podcast. We have coaches on here. We talk about business planning. We talk about things that you can do to grow your mortgage and real estate practice. And look, the reality is one of those things, it may not feel like it's sales related, but it's getting control of the vices within your life, and alcohol being a major one for people in this industry. So check out that book. The reason I recommend the audio book, by the way, because I'm not going to lie to you, there is some, NLP going on with this book, right? Some neuro-linguistic programming. And I think that picking that up by reading it at your own cadence, maybe for some people that works really well. For me, I just don't retain nearly as well when I read something myself. But having it presented to me orally is, for me, it just resonated. So I just had it at Audible. I just listened in the background while I'm driving, doing my thing. And like I said, it's not like if you start the book, you have to commit on the first chapter to not drinking. Doesn't work like that at all. But I highly recommend it. And look, if we're 6 months down the road and you've checked out that book and you have good results from it and it helps you control alcohol, as the title says, I'd love to hear about it. Anyways, okay, let's talk about the housing market in 2026. I love Logan. I suggest that you guys check out his content. He used to do interviews and whatnot. He's pretty exclusive with Housing Wire now, and you have to have a paid subscription to read his articles. And so I do pay for that subscription, and I'm not going to read the article to you, but I'm going to give you some of the highlights because I think that this is a very reasonable view on what's going on in the housing market in 2026. And I think a lot of this is driven by interest rates obviously being at a low right now. They've definitely been a little bit, up and down as rates tend to do. But you guys, we ended up 2025 in a pretty good place with interest rates. And just over the last few weeks, there's been some down days, but the trend has been for improving interest rates. And you couple that with the spread between the 10-year and mortgage rates, which we're going to talk about what that did in 2025. I've talked about it a number of times on this podcast because it was a huge factor that was keeping interest rates from being as low as they otherwise could have been. I will tell you, if that spread had not come down over the last couple of years, our rates would still be up in the sevens. To give you an example of how much of an impact that spread has in the overall interest rate. So let's just talk about the housing market. Now, here's the first thing Logan talks about, and it's inventory. You guys, I don't know if you're keeping an eye on it, but inventory is, he says, near normal levels. I think historically they are near normal levels. We see about a 4-month inventory right now on the market. It's nowhere close to the highs though that we've seen at other times where, we would say there was a lot of inventory, but we're definitely getting closer to more normal levels of inventory, which is great because it gives people options. And I think it does start shifting things more towards a little bit of a buyer's market. And I think you're feeling that. I mean, you see that with home prices, you see that with price drops and so on and so forth. So we're going to probably have my buddy Anton on here, who's usually a regular guest that we have once or twice a year. We're going to talk about what his perspective is on what's going on in the real estate market around this stuff. But nationally, what we see is inventories near normal levels, and that's very healthy. We haven't seen this for a very long time. If you remember, when rates were really, really high, we had such little inventory that we continued to see house prices go up, even though affordability was brutal. And so this factor alone is huge in making sure that things don't continue to get more unaffordable because there is more inventory, just basic supply and demand. So he talks a little bit about what his forecasts were, which were rates ranging between 5.75% and 7.25% in 2025. And I would say that was pretty spot on. And the range that he gave for 2026 is still 5.75%, but with a high of 6.75, kind of in that range throughout the year. And there's a few X factors that could change that. So we're going to talk about those towards the end here. And here's the big thing that's helping rates be lower right now. We've talked about this a number of times, and it is the labor market, right? So we see inflation pretty much in check, and we see a weak labor market. So the thing that he's saying that could really push rates towards the higher end of his forecast is if we see strength come back to the labor market. So keep a close eye on that. I think that's pretty obvious to those of us that watch this all the time, but not everyone that watches this podcast is an expert at the market. So watch the labor jobs, watch the employment numbers. That's going to be, if we see strength come back in there, that's the thing that could push us up. But I don't see him going super high. He also says in here, I don't see a major breakout lower with interest rates. Like I don't see a magical refinance boom coming. But I'm going to talk about another article, in a future episode that I was reading. It might have been Logan's as well. I think it was on Housing Wire, but it was talking about the number of outstanding mortgages right now that are that there's more outstanding mortgages above 6% than below 6%, which I thought was super interesting. I think that's what it was. We'll dive into it a little bit deeper, but it kind of challenges the idea of the lock-in effect. And is that really a factor that's driving seller behavior today, right? Because we all think the lock-in effect is a major factor, but is it really? We're going to talk a little bit more about that. Okay, so what he does say is, I have a tough time predicting rates go below the 5.75. And personally, that's kind of the range that, if you remember a couple episodes ago, I had Jason Obradovich on, and we talked about, kind of that high 5 range. I think anything with a 5 handle is going to be great in 2026, and I expect we spend a lot of the year in that range. As loan officers know, it's really tough being on that bubble, right? When rates are 6 1/8, like everyone wants to be 5.99. And so there's this psychological barrier when we're between a 5 handle and a 6 that make it difficult from a price comparison, and pricing exceptions and things like that tend to kind of get elevated a little bit in a market like this. So I don't love that aspect of it. But if we see rates in the low 6s, high 5s, I think that's going to, be very good for 2026. So I'm quite optimistic about all of this. Okay, so the bond market, if the bond market really fears a recession, you guys, I think that could be another factor that will help interest rates push a little bit better. And I think there was a big fear of that when the tariffs came out in 2025, and yet there was not a recession as a result of that. So it'll be interesting to see if this continued weakness in jobs and whatnot we start getting that talk of recession again. I've not heard that yet. So it'll be interesting to see what happens there. Now, let's talk about the spreads. This is super interesting. So mortgage spreads, historically, the spread between the 10-year and 30-year mortgage rates is about 1.6 to 1.8%. We've talked about this a number of times. In 2023, that difference reached as high as 3.1%. And so that's what I'm saying. If that 3.1 was still in place today, we would see rates in the 7% range or over 7, by mid 7s. The forecast for 24 and 25 was for improvements in the spreads, and that's absolutely what we saw. So let's dive into those numbers. The forecast for spreads in 25 was that they would drop from 0.27 to 0.41 drop. Improved based on a 2.54 average in 2024. So they were 2.54 in 2024. They were expected to drop 27 to 41 bips. They ended 2025 at 2.05. So that's a 0.49% drop. And Logan's predicting that continues, as Jason has predicted as well in my previous conversations, and we do return to that normal level of about 1.8% in 2026. So you guys, that's another 25 basis points improvement from where we are right now today. So you couple that with continued weakness in the labor market, inflation stays calm, and that's the formula that's going to get us into that, upper 5 range here very quickly, I suspect. And that's very good news. So you have more inventory, you have, good data that I think supports where interest rates are going to go. And then you put on top of that that we now have more inventory for people to choose from. We have more sellers that are, have higher interest rates and would be willing to sell. And I think those people that are holding those 3% mortgage rates, that's been going on now since COVID, right? Since that's 4 years, 5 years, they've been in those homes. And as we're going to talk about in that other article, there's other factors that lead to people buying a new home besides just their current interest rate. So all of that, in my opinion, means more purchase opportunity. If you look at where rates are at right now, if rates stay at 6.25 or below in 2026, that's 237,000 more buyers that can enter the market with a 6.25 or better interest rate. And that's significant. That's going to drive more sales. What we see is when rates hit that 6.65, 6.64 range, that's where the wet blanket starts getting put onto the fire, and we see people back off. And it's just historically worked that way when rates get over 6 5/8, somewhere in that neighborhood. So home prices expected to actually decline a little bit is what he talked about. The forecast for 2024 was 2.33%. That ended up being 4% growth in 2024. And then I think 2025 forecast was 1.77, and that's about where Logan expects it to come in. But the projections for 2026 are inventory growth, with the inventory growth and everything, and rates staying a little bit elevated, but still improving, that home prices might be down as much as 0.62%. So less than 1%, but still a little bit of a drop because of the increased supply that's going to be available in the market. Now, I think another thing to remember here is I know a lot of people talk about that they don't feel like the wages are keeping up with inflation, right? You hear that a lot. The prices of groceries have gone up so much, but my paycheck hasn't. But statistically speaking, you guys, people's income has outpaced the increase in home prices. And so really, affordability, with interest rates getting a little bit better, affordability is looking better than it has in a while, believe it or not. And so I think that's a good factor to remember, is that we do still see incomes going higher. We see record lows as far as foreclosures. We see the highest credit scores that we've seen pretty much ever, because people have equity, and as a result, they are able to find situations to restructure their debt and things of that nature. We've talked a lot about cash out refinances. People have the means, homeowners, have the means to make their finances work better than they have in the past because of the equity position that so many people are in. So overall, you guys, 2026 is looking like a very solid year for those of us in mortgage and real estate for all those reasons that I just reviewed with you. And here's the X factor. Now, we've talked about some of the crazy stuff that's already been proposed by the FHFA, right, and by the Trump administration, this idea of a 50-year mortgage, portable mortgages. There was a policy, like what was it, the home affordability policy or something like that. I don't even remember what it was called. But the point is that the current administration has a focus on housing. Now, so far, they've, kind of whiffed with the first couple ideas, but that doesn't mean that they don't come out with something in 2026 that is, that is going to help fuel this market. Now, we obviously know Jerome Powell is out this year. So does it come via the Fed and a more dovish approach to, the overall Fed? We've already got some Fed chair members, swapped out. Now we got a new chairman. What does that do? So that's a factor, definitely driven by the Trump administration, but they might have other ideas and strategies that they roll out, and some of them might hit. So that's the X factor. And I would say even without that, I feel pretty optimistic about 2026 versus the last couple of years. We've slowly started thawing out from the chilling, season that we had in 2022 and 2023. 24 was better, 25 was better than that. And you guys, I think 26 is going to be even better. And with a few possibilities of things to get really good. Also, don't forget, despite what's going on in the housing market, as far as strength in sales and more inventory, this also means that with rates in the high fives, there will be continued refinance opportunities throughout 2026. I still think a majority of them are going to be your more strategic refinance opportunities, helping people consolidate debt, purchase investment properties, things of that nature. But there will also be, I think, quite a few rate and term opportunities, or rate and term while removing mortgage insurance or switching to a lower, shorter term mortgage. I think all those are reasonable possibilities. And as I've also talked about in the past, you guys, non-QM. Non-QM is a massively emerging part of our market. If you're a loan officer that's not up to speed on what's available in the non-QM space, I strongly encourage you to get to know those products intimately, because I can promise you, you've had borrowers that you met with that you think didn't qualify for a mortgage based on traditional guidelines, and you'd be right, but they very well may have qualified for one of the non-QM options out there, depending on their employment status, if they're self-employed, if they, have assets that they could leverage, if they have rental properties and need a, DSCR loan. There's opportunities there to pick up a couple transactions a month if you make it a focus of yours, but you got to understand those products so that when those opportunities literally land in front of you, when you're talking to a customer that you think doesn't qualify for a mortgage, you got to be making sure you're looking at non-QM options for all of your buyers as well, because interest rates on those have continued to improve as well. Not a huge spread between conforming rates and non-QM, and I'm seeing more and more transactions happening in the non-QM space. So don't forget about that in 2026. And that's all I got for you guys today. Look, this is going to be a great year. I'm excited about some of the guests that we have scheduled coming up here on Market Shares. As I mentioned, in 2025, we want to grow this channel. So let people know about what we're doing here at Market Shares. Share this with somebody. If you're not a subscriber, please consider subscribing. Let's push that number up over 1,000 here in 2026. I think that'd be a huge goal. And keep in mind, if you want to see the next episode, just subscribe and it'll be presented to you next Friday, because every Friday at 10 a.m. we drop a fresh episode here at Market Shares. And until then, take care.